In October 2002, formerly known as Kanye West, lost approximately $1.5 billion. Adidas dropped him, Gap dropped him, Balenciaga dropped him. Every contract, every partnership, every brand deal gone in weeks. What happened to Kanye West in 2022 is mechanically identical to what happens when a stock crashes. It's the same logic, the same speed, and the same panic. And if you understand why his brand collapses, you understand securities better than most people. And today I'm going to give you the full securities curriculum. What they are, every single type, how you value them, the differences between speculations and investments, and what volatility actually means. Entirely true, the cancel culture and the celebrities you already have an opinion about. Yeah, it's gonna be a lot of fun. Before the drama, we need to handle the legal definition. I really am a nerd when it comes to it, because the definition of security is usually what comes from a 1946 United States Supreme Court case, and is still the governing standard for everybody. It is called the Howey test. The Howey test says something is called a security if there is an investment of money in a common enterprise with an expectation of profit derived from the effort of others. All four elements must be present to call something security. Now, apply it to Kanye West's Yeezy deal. Investment of money, Adidas invested billions. Common enterprise, Adidas plus Ye together. Expectation of profit, royalties, shoe sales from the effort of others, Kanye's creative direction, and Adidas manufacturing. That is a security structure. The law does not care whether an asset is a share or sneakers. In the US, securities are regulated by the Securities and Exchange Commission. They are the referees of the financial world, and they have the enforcement power. So what kind of things really count as securities? Stocks, bonds, derivatives, options, ETFs with a completely different purpose, different risk profile, and different investor base. And we're going to go through every single one of those. And I'm going to compare it to pop culture because I needed somebody to explain it to me when I was learning it like this, okay? Type 1, stocks that everybody's talking about. When you're buying a stock, you're buying a small piece, a small ownership of an enterprise, a slice of its future earnings, growth, assets. If the company collapses, you don't. Imagine Taylor Swift is a brand and she's a publicly traded stock. She would be the single best performing asset of the past 2 decades. Between Taylor Swift in 2006 was a small artist, you invested in it, and now she exploded, and you would gain a lot of money on that. So she's worth now around $2 billion or something. This is what equity appreciation looks like. And some celebrities have literally became equities, like Rihanna's Fenty Beauty, which drives the majority of her billionaire status. Selena Gomez with Rare Beauty. They stopped working for a check, which is like if they go, they perform, they get a check for performing, and now they own something. Stocks come in 2 broad flavors. There are growth stocks, which reinvest the money that you put in for further business expansion, and you don't get the payment now, you do get massive results in the future. And there are value stocks that pay reliable dividends and grow steadily. Again, Taylor Swift, she reinvested into the Eras Tour, etc. to gain more and more. And there are also some celebrities that grow slower, that produce music consistently, that don't do anything crazy, but they get dividends all the time. And both types of stocks are excellent investments, just with different profiles, Now let's move on to type 2, bonds, where stock represent ownership, bonds represent debt. When you buy a bond, you lend money to the government or a company, and they promise to repay you with interest on a fixed schedule. They're more predictable, they're more reliable, they're lower risk than stocks, but also lower potential return. Jennifer Aniston's Friends contract, $1 million per episode. That is a bond behavior, fixed rate, fixed dividends. She delivers a performance in the network place. So it's not more if the episode is a hit and not less if the episode is not watched that much. Bonds are rated for credit risk. AAA is the most reliable, almost guaranteed to pay. Junk bonds are the riskiest, high potential return, but also a high probability of not being repaid, real possibility of default. Oprah is an AAA bond. 40 years of trust, pays your obligations, no drama, a junk bond. The yield is higher because there is a faster growth potential. There's also the fact that they can just not make music anymore. And bonds can default, so the issuer can't pay. Imagine if Friends were to sign with Jennifer Aniston and then just not start, just not film, just fail from the very beginning. So both sides would find themselves in the middle of a breach of contract completely. Bond-like instruments are like Spotify giving a fixed commission to their artists. Now let's move on to type 3, which is derivatives. It's a financial instrument whose value is completely derived from something else. It has no independent value. This is where finance gets genuinely complex and genuinely useful. Taylor Swift's merch is a derivative. A Thor t-shirt is fabric. It costs about, let's say, $4 to manufacture. It sells for $60 to $90 because it is connected to Taylor Swift's brand. If Taylor Swift's brand would collapse tomorrow, the shirt would cost $4. The merch derives its entire value from the underlying asset, which is the brand. This is a derivative. By the way, if you're enjoying this video so far, I'm Mehin, I'm a law student. I'm on the road to 2,000 subscribers. And if you want to learn more about finance, law, explained in very simple terms, I would love to have you here. Subscribe. And then there's the version of that is genuinely insane. Futures and forwards are versions of derivatives that lock in a price for a future transaction today. So a label signing an unproven artist for a multi-album deal. So they're locking in today's price for future output they have not yet received. That's a little risk, you know? So the next type of securities are options. And an option gives you the right, but not the obligation, to buy or sell an asset at a specific price at a specific time window. You pay a premium upfront for that ability. Then you decide whether to exercise it or not. A call option, the right to buy at a set price. You use this when you believe the price is going down. Let's go to Johnny Depp versus Amber Heard, April to June 2022. As the trial progressed and the public opinion shifted, and anyone who believed Depp would win and his brand name would recover was effectively holding a call option on Johnny Depp's reputation. Options exist because uncertainty has financial value. The right to decide later is worth paying for today. Type 5 ETFs, a track of securities that tracks an index, sector, or collection of assets. Instead of buying one stock and hoping that it works out, you buy a fund holding many assets at once. If one crashes, the others absorb the impact. Diversification is the core principle here. Let's go back to BTS. It's an ETF. When you invest in BTS as a group, you're not betting on one member. When Jin entered the military in 2022, BTS didn't collapse, right? No single holding can destroy the whole fund. So now that we've discussed the types, let's move on to valuation. You now know that securities exist. But how do you know what they are worth? Because a security is only worth when somebody will pay for it, right? And that number is defined by 3 key factors. Approach 1 is fundamental analysis. So 3 different types of analysis. Firstly, fundamental analysis. You study the actual numbers like revenue, earnings, debt, growth rate. You try to calculate the value like independent of what the market thinks. What is this generating? What should the math say? Let's have a fundamental analysis of Taylor Swift. The Eras Tour grossed over $2.2 billion across 149 shows. Now she's the first person to achieve billionaire status through mostly music, like outside other business ventures. Now, approach 2 is technical analysis. You study the price history. So you look for patterns when support levels when the price has risen before, resistance levels where it has stalled, and trend lines that predict the next move. So the argument is human psychology predicts what's going to happen to an asset. Let's go to Justin Bieber's career. In 2009, there was an explosive breakout. In 2013, 2014, there was a crash. 2015, Sorry and What Do You Mean? Strong reversal candle. 2016, Purpose album and breakout continuation. A technical analyst identifies the recovery pattern at the bottom and enters before the full reversal confirmed. This is technical analysis. Approach 3 is the market's sentiment. It's the most human and the most volatile of them. It's about what people feel about an asset. So now that we understood valuation, let's move on to speculation versus investment. And this is one of the most important distinctions in finance. Understanding the difference between speculating and investing, even though they look similar on the outside. An investor makes decisions based on underlying value. They do not panic in periods of short-term volatility, short-term market noise from long-term stability. Most of your favorite celebrities have been at the point of their careers, of their lives, when they have been nearly canceled. Some people left the fandom and some stayed because their reputation recovered later. This is how an investor works. A speculator functions on market, on prices, on how they work in this specific moment. It doesn't mean it's wrong, it's just a different strategy. It's natural, but investments are what drive wealth. And short selling needs its own explanation. A short seller borrows shares, sells them at the current price, and bets the price will drop. so they can buy them back cheaper later, or return the borrowed shares and pocket the difference. They are betting on a fall they believe is already happening. Tabloid media is the short-selling infrastructure of the celebrity world. They borrow public attention, sell the scandal at a peak outrage, and exit before the nuance cycle begins. They are short sellers on a human brand value, and they're extraordinarily good at it. Now let's move on to volatility. Volatility measures how dramatically the price of an asset moves throughout a certain timeline. High volatility means enormous swings. Low volatility means slow, progressive direction. Neither is inherently good or bad, they're just different. There's also a volatility index, the fear index as they call it. It measures how much uncertainty there is in the stock market right now. When the fear index is high, everybody's panicking, and when it's low, everybody's happy. It's Kanye West. High volatility. You don't know what's going to happen with his reputation. It drops like crazy. Then somebody likes him. Then it drops again. Beta measures how much the asset moves relative to the whole market. A beta of 1 means that the asset is moving with the market. Above 1, it amplifies. And below 1, it dampens them. Billie Eilish is a high beta celebrity. Her brand amplifies every shift in Gen Z's mood. By the time a scandal is on Twitter, it has already moved. By the way, if you want to see more videos on finance explained simply, I have a ton of them on my channel. And if you like this video, I would love to have you on the team. Subscribe.